If you earn a paycheck in the United States, the tax system doesn't wait for permission. Federal income tax, payroll tax, state tax. Before you ever touch your money, the IRS has already taken its share. For many workers, that means 22 to 24% federally. For high earners, it can reach 37% before state taxes and payroll deductions even enter the picture. That's the system most people know. What almost no one is taught is that this immediate taxation applies mainly to income from labor. Banks don't live in that world. Banks don't earn wages. They don't rely on paychecks. They operate through assets, liabilities, and balance sheets. And the U.S. tax code treats those forms of money on a completely different timeline. Same dollars, different rules. This video is not about hiding money or breaking laws. Everything we'll discuss is legal, documented, and grounded in how U.S. financial policy has worked for over a century, going back to the creation of the federal income tax in 1913. In this video, I'll explain why earned income is taxed the moment it exists, but asset gains are not. Why borrowed money is not considered taxable income by the IRS. How banks legally use assets and debt to control when taxes are triggered. Where these rules came from in U.S. history, especially after the Great Depression and later in the video. How understanding these same rules can change. How you evaluate money decisions without crossing legal lines or playing games with the IRS. This isn't financial advice. It's financial literacy. Once you understand how the system distinguishes income, assets, and debt, you stop asking how to pay less tax and start asking a much more important question. When does the tax clock actually start? The U.S. tax system does not tax money. It taxes categories of money. The most heavily taxed category is earned income. Under IRS rules, wages, salaries, bonuses, and business income are taxed in the year they are received. That means a worker earning $100,000 doesn't get to decide when taxation happens. The IRS decides for them. At the federal level alone, marginal rates range from 10% to 37%. Add payroll taxes, 7.65% for Social Security and Medicare, and state taxes in places like California or New York, and total tax exposure can easily exceed 40% of every additional dollar earned. Assets operate under a different legal framework. If you buy an asset for $100,000 and its value rises to $150,000, the IRS does not tax that $50,000 increase because nothing has been sold. This is called an unrealized capital gain, and under U.S. law, unrealized gains are not taxable. Taxation only occurs when the gain is realized, meaning the asset is sold or disposed of. At that point, capital gains tax applies, often at lower rates than income tax, 0, 15, or 20% federally for long-term holdings. Banks are structured around this distinction. They are designed to accumulate value inside assets, loans, securities, equity positions, rather than channel value through taxable income. This allows balance sheets to grow for years, sometimes decades, without triggering major tax events. For individuals, this same rule already exists. It's why owning an asset that appreciates is treated very differently from earning another paycheck. Later in the video, we'll connect this principle to everyday financial decisions, not as tactics, but as a framework for understanding why the system rewards ownership and patience far more than constant income. One of the most misunderstood rules in the U.S. tax system is also one of the most important. Borrowed money is not considered taxable income. Under IRS definitions, income represents an increase in net wealth. Debt does the opposite. When you borrow money, you receive cash, but you also create a legally enforceable obligation to repay it. There is no net gain, so there is no taxable event. This rule isn't optional. It's structural. If debt were taxed as income, modern banking would be impossible. Mortgages, business loans, student loans, and corporate credit would all collapse under immediate tax burdens. Banks depend on this rule to function. When a bank takes in deposits, issues bonds, or borrows in short-term funding markets, it may receive billions of dollars in cash. None of that is treated as taxable income because it sits on the liability side of the balance sheet. This is why a bank can control hundreds of billions, or even trillions of dollars in assets while reporting far smaller taxable profits. To make this concrete, if a bank borrows $10 billion at 4% and lends it out at 6%, only the net interest spread, in this case, roughly 2%, is considered income. The borrowed principal itself is never taxed. Individuals already interact with this rule constantly. A mortgage doesn't trigger income tax. A car loan doesn't either. The IRS only cares when value is earned, not when money is temporarily accessed. Later in the video, we'll connect this idea to how banks legally use debt alongside assets to manage cash flow and tax timing. Not as a strategy to copy, but as a lens to understand why the system behaves the way it does. Once you understand that assets aren't taxed until they're sold and debt isn't taxed at all, the core banking model becomes clear. Banks don't prioritize selling assets. They prioritize holding them. Selling an asset converts an unrealized gain into a realized one, and that's when the IRS steps in. So instead of selling, banks borrow against what they already own. This is how tax timing is controlled. Imagine a bank holds a portfolio of loans and securities that has increased in value by $500 million over time. If the bank sells those assets, that gain becomes taxable. But if the bank uses those same assets as collateral to borrow, it gains liquidity without triggering a tax event. No sale. No realization. No immediate tax. This is standard balance sheet management, not aggressive accounting. U.S. banking regulations actually encourage this behavior. Capital adequacy rules, introduced after the Great Depression and reinforced after the 2008 financial crisis, are designed to keep banks solvent while allowing them to operate through economic cycles without forced asset sales. This focus on timing creates a powerful advantage. Deferring a tax bill for 10, 20, or even 30 years allows capital to continue compounding inside the system. Historically, long-term U.S. financial assets have returned roughly 7 to 10% annually, meaning deferred taxes quietly lose real value over time due to growth and inflation. Individuals experience smaller versions of this dynamic whenever they hold investments instead of selling them. The principle is the same even if the scale is different. The system doesn't reward speed. It rewards patience and structure. The way banks are taxed today wasn't designed in a vacuum, and it wasn't designed to be generous. It was shaped by failure. Before 1913, the United States didn't even have a permanent federal income tax. Government revenue came largely from tariffs and excise taxes. When the 16th Amendment passed, lawmakers quickly learned that taxing labor was simple. But taxing capital was dangerous if done incorrectly. That lesson hit hard during the Great Depression. Banks didn't collapse because they lacked income. They collapsed because they were forced to liquidate assets into falling markets. Once assets were sold under stress, losses became real, capital vanished, and credit froze. The response reshaped the system. During the 1930s and 1940s, U.S. policymakers deliberately built a framework that allowed banks to hold assets through downturns, carry losses forward instead of realizing them immediately, use debt and deposits without triggering tax events. These rules were reinforced through legislation, court decisions, and regulatory policy. The goal wasn't fairness, it was stability. After World War II, the same structure helped finance massive economic expansion. Housing through mortgage markets, infrastructure through bond markets, and corporate growth through long-term lending. For decades, asset-based taxation allowed banks to operate continuously without collapsing every time markets turned volatile. This is why capital gains are taxed only when realized. It's why debt is an income. And it's why balance sheets, not paychecks, sit at the center of the financial system. These rules weren't written for banks alone. They were written to prevent another systemic collapse. Understanding that history explains why the system still works this way today. Once you understand how income, assets, and debt are treated differently, the system stops feeling random. Most people spend their entire financial lives inside one lane. Earn income, pay tax immediately, repeat. That lane is simple, visible, and heavily taxed. Banks operate in a different lane. They focus on structure, not effort. They care about how money is classified, when it's recognized, and how long it can remain inside assets before becoming taxable. This doesn't mean copying banks or trying to outsmart the IRS. It means understanding the framework you're already living in. Two people can generate the same economic value and face completely different tax outcomes. Not because one cheated, but because the form of money was different. Income gets taxed first. Assets get taxed later. Debt isn't taxed at all. That's not unfairness. That's architecture. This is also why this topic isn't taught clearly. The system functions best when taxes on wages are automatic, predictable, and rarely questioned. Explaining balance sheet logic to everyone doesn't help policymakers, employers, or institutions collect revenue smoothly. So financial education stays focused on budgeting, saving, and spending. Important skills, but incomplete ones. Understanding these rules doesn't magically reduce taxes. What it changes is how you evaluate decisions. You start asking different questions. Or is this income or an asset? Or is this a taxable event now, or later? Oh, who controls the timing? That shift alone puts you ahead of most people. Because in finance, the biggest disadvantage isn't paying too much tax. It's never learning how the rules actually work. RK. If this video gave you a clearer picture of how the system really operates, that's what this channel is about. No shortcuts. No hype. Just structure, history, and reality. Subscribe if you want more breakdowns like this so you're not reacting to headlines but understanding the system underneath them.